All right, we are going to look at a newborn child in this case study. We are going to look at an individual age 0. So an infant, we'll assume that the parents, perhaps you're considering this right now, are considering a policy for their child. The purpose, their plans for the money are as follows. We'd like to look at college planning, and then also a scenario where we just pump money into a policy and look at building up a nice cash value life insurance policy with a life insurance death benefit as well for my child. If I start young, when the costs are next to nothing, how much money will they have when they're my age? I'm 30 now. Maybe we're looking at it for a grandchild. We're in our 50s or 60s. How much cash value will build up if I pay in a very small amount? Maybe it's a large amount. So we're going to look at those two options. And for the funding, what we're going to look at here are two options. For the college funding scenario, we are going to look at funding a policy at $5,000 a year through age 18. When it comes time to pay for school, how do I actually use the policy? How do the loans work? All of that fun stuff. And then for the long-term savings example, we're going to look at a small amount of funding, $2,000 per year, but for a long period of time, 50 years. So this is interesting. It will be interesting, I should say, when we look at how those policy values build up over time. And we're going to look at a couple companies here as well, because anytime one is considering a cash value life insurance policy, we do like to show them multiple options. If we could emulate what we can experience with Amazon, where we see several options when we go to purchase a product, different price points, and we can pick the option that actually fits best to me, what I'm trying to accomplish, and I don't have someone there selling me or trying to steer me in one direction, that is excellent in my opinion. Very transparent, everything's easy. Our goal here really as our company is to emulate the exact same thing, make it very transparent and then very convenient for the individual we work with. So let's get into it here. Let's look at some numbers. What we'll start with is the college funding scenario, because this question comes up so much. You know, cash value life insurance for college funding is very popular. A lot of college planners around the country heavily utilize cash value life insurance. And the reason why is if I'm a parent and I go to apply for financial aid for my child, cash value life insurance, the cash values are typically not considered an asset on my balance sheet, call it my personal balance sheet. For example, if I apply for financial aid and I have to disclose all of my financials, cash value life insurance can often be excluded. Now you could make the case to say, hey, if you have $300,000 in cash value, just pretend I'm the college saying this to you, before we provide any aid here, you need to use that cash value. That's an asset. Well, the argument on the other side of the fence is, if you're the policyholder, say you're the parent, well, college, university, if I touch the cash value in here, my death benefit will decrease. And the death benefit is utilized for income protection. That's for my family. So I don't necessarily want to touch it right away. So that's where that argument can hold up there. That's one reason. There's more to it. It's also important to be aware of the state that we reside. Different states have different rules and such, but we're going to go through how the policy works here. So what we've got is a policy designed for maximum cash value with one of the 4 major mutual companies paying in $5,000 per year, age 0. Why we see year 1, age 1, is that is his age at the end of the first policy year. So he pays in $5,000. We have a high early cash value product here, meaning it is geared for maximum early cash values, especially during the first 20 years of the product, because our goal is college planning here. I want to get as much money as possible based off of my dollar input in order to pay for college. So, excuse me, 5,000 in, about 45, almost 4,600 right off the bat. Break even point just about year 4, where I am $20,000 into the product total, 5,000 for 4 years, and I've got 23 bucks short of 20,000, $19,977. Substantial death benefit as well, typically for An infant, we look at it and say, hey, the death benefit's not our concern at all. Long term, sure, but this is a complete cash value play right now, trying to prepare our child for the future. So we're going to fund the policy up until age 18, $5,000 per year, and then we are going to take out $30,000 loans for 4 years to help support college costs. Now, you might be looking at this and could easily argue college is going to cost a lot more than $30,000 per year 18 years from now when we're shooting this video in 2021. Will it? Yeah, most likely. Depending on where we go, the cheapest schools might cost that. Conceptually, though, this will help us grasp exactly how a policy works. So, funding, by age 18, we have just short of $125,000 in cash value, and now we're going to look at policy loans. So this column here represents our annual loan. Then we have our loan interest, loan repayment in purple, and then loan balance in dark red. Okay, so anytime we take a policy loan, what I want to understand, if I'm the consumer, if I'm you, if we flip positions and I have the knowledge that I have on life insurance products, I want to know the impact of a loan on my life insurance policy. So on the left, this is why we have the growth sample here. Year 19, if we did not touch the money, let's pretend that our kid got a full ride and we don't need to access any of this money. Our cash value is $128 and change. Death benefit is $1,150,000. We take out this $30,000 loan. There's my loan balance. The gauge that determines how much I can loan from a policy is my cash value. Think of it this way. This is the equity that determines how much I can borrow. So my cash value dropped from 128 to 97. My death benefit drops by how much? When I look at it over here. Almost dollar for dollar, the $30,000. We have the loan interest there as well, but we're seeing whatever my loan balance is, my death benefit is held as collateral. So to go back to how policy loans work, if you have not seen any of our content on policy loans, that is, a huge advantage to taking loans from a life insurance policy is that I am still going to earn dividends on any money in cash value and any money outstanding in loans as if I never touched it in the first place. Just like a piece of real estate, if it appreciates by 5%, doesn't matter if I have a loan outstanding or not, I continue to receive that appreciation. So I take these $30,000 loans out. Here's my loan balance. Now, why it is growing by more than $30,000 per year is interest is accruing over here on the left, and I am not paying any of it. So if loan interest is due and I do not pay it as the policyholder, what happens is the policy borrows from itself, specifically from the cash value, to cover that loan interest cost. And my death benefit is collateralized as well. So by age 22, paid for the last year of college, got about $9,000 left in equity. But remember, I'm still earning dividends as if I had $144,000 in cash value. My death benefit collateralized by the loan balance of $129. So that's at the last year of school. Now, after the 4 years of college funding, we begin to pay the policy loan back. Now, when it comes to loan repayments, it is 100% optional, and I can pay it back how and when I want, which can be a little confusing sometimes. When I hear the word loan, what comes to my mind is payments and interest. Policy loans are a bit different. Why they're so appealing to many is when I take a policy loan, if the policy does not lapse or is not a MEC, I can access those funds completely tax-free. That's why this is used so often. Now, as we start to repay the policy loan, let's look at this. And keep in mind that point we mentioned, that we continue to earn dividends on any money in cash value and what we've loaned out as if we never touched it in the first place. And this is really what I want to hammer home here. We're paying it back at $1,000 per month. We can pay it back sporadically if we want. The loan interest, by the way, I don't want to just neglect that. With this company is at 5%. As we're paying it back, when that is repaid, what does our cash value and death benefit look like compared to the example on the left, where we pay money in and just let it sit and grow? Is there any difference there? No, the values are 100% restored to exactly what they would have been as if we never touched it in the first place. And these are illustrations we pulled directly from different insurance carriers, in this case the same insurance carrier, one without loans, one with loans and paying them back, and then just imported them onto Excel for simplicity. But the point here is, if we borrow and repay, our money continuously compounds for us. This way, if we pay it back at any point in time, our cash value is 100% restored, again, to exactly what it would have been as if we never touched it in the first place. No lost opportunity cost, things keep on moving forward. So, one demonstration there on how to use money for college planning. There are many ways to model this, whether it's larger policies with larger loans, paying nothing back, paying interest only over time. Those are all good things to look at. It's important to see that whenever we demonstrate loans for anything, which we've got other videos and case studies on. So let's go back to our spreadsheet and look at long-term savings. So let's assume we take a policy out not for college planning, but just to take a newborn child and pay into a policy for a long period of time. We're going to look at two companies here just to provide some variety. There we go. A little bit bigger, a little bit smaller. And there we go. So on the left, we have a policy geared for a little bit stronger upfront cash value. Always, again, good to see options. We've got two different companies here actually, but more upfront cash value, $2,000 in, $1,600 in cash value immediately. There's my death benefit. There's my internal rate of return. And this is important because often life insurance is sold, it shouldn't be sold in the manner that I'm about to explain, but it's sold in the sense to say, hey, here's a company with a 6% or 5% dividend rate. That's great, that's what you're earning. The thing is, that's not what we're earning. Whenever we see a dividend rate, or even a guaranteed rate for that matter, that is a gross rate that is applied to my policy after the company's insurance expenses and mortality charges. I want to look at the net internal rate of return, which simply shows how much is my cash value growing by if I just run a calculation on it. So, see, it's negative here the first 3 years, year over year. If we pumped more money into it, we could make it stronger. We just used a small number of $2,000 per year. We've got our cumulative outlay, total out of pocket over time. This helps us track our break-even point. In this example, about year 7. And we're going to fund this guy for 50 years. Let's look at company 2 first. Similar design, a little bit different. Upfront cash values are weakened. With this particular company, we had some restrictions on that for a 0 year, an age 0 individual. Annual internal rate of return and average internal rate of return. The annual isolates year to year. For example, if I state, hey, I earned 30% in the S&P 500 last year, that would be my annual IRR. If I look at my average, the question would be, what did I earn over the past 30 years in the market? That's my average return, factoring in the early years that are negative and the later years, which are the best years of a life insurance policy. So time passes, annual IRR picks up, and that pulls up the average over time. Here's really what I want to look at. As I continue to pay money into this policy, $2,000 per year, what does it look like as time passes? Let's look at age 25 first. I've paid in a total of $50,000. And what do you have? $79,000 with Company A and $81,000 with Company B. Not a huge difference. And here's one thing I'll add as well. If we're projecting out 25 years on an illustration based off the company's current assumptions or current dividend rates, things are going to change. These values are not going, the actual values will not represent what we see on a life insurance illustration. Always good to look at the current rates, the current dividend rates and such, but look at a more conservative interest rate, conservative dividend as well, the guarantees as well. This way I can see everything up front, not just hear about it, and properly set expectations with more of a conservative or worst case scenario. If I'm good with it based off the horrible looking numbers, then I'll be satisfied with everything else. Time continues on. Let's look at age 50. When we've concluded the funding, we may have decided to transfer this to our child at some point in time and say, son, daughter, I'd like you to take over the funding now, $2,000 per year. Look at the incentive. So at age 49, $2,000 goes in. Cash value grows by how much? $16,000. Imagine if a policy set up for you as a child, you inherit it 20 years, 30 years down the road, you're putting $1 in, you get that dollar back plus a lot more on top of it. Simply due to the compounding, the insurance expenses being behind you for the most part. That's the key. We're getting over the early years for a newborn child when we don't even know they're there. That's the appealing part. So we stopped funding here at age 50, cash value $326,000. Over here, $364, just about $365. We can see that in the annual internal rates of return. Company B has more money, a little bit stronger over time as well, stronger net cash value. Now we can easily continue to pay into it, but we do not have to. We stopped after 50 years in this example. 100,000 total in, that's why we stopped there. Simple number in. Here's our cash value, growing at a healthy rate over time as well. And let's not neglect the death benefit here. I'm age 50, I've got $1.1 million with either of the options I selected. I've got life insurance protection, and the cash value is the attractive part. This is why my parent or you as a parent originally purchased this for your child, but now they've got a death benefit there too, where perhaps they do not need to go out and get term insurance, anything like that, because they've got sufficient coverage here, depending on their situation, how much you're paying into the policy. All situations are different. But we've got a nice cash value asset here, safe, liquid, tax-free. Money continues to compound for me over time, no matter what happens with ups and downs in the market, the economy, all of that stuff. This just keeps on going up, and I've got the life insurance protection. So point here to all of this is cash value life insurance can work very well for a newborn. Setting the policy up properly, like an individual of any age, is very important. However, starting young allows us to get over the insurance expenses very early when they are very low. And then as time passes, it just gets better and better. And if our plan is to eventually gift that policy or transfer it to our child, say when they're 20, 25 years old, now they have a real incentive to keep on adding money into that product only because it's moving at a nice pace. They pay $1 in, they see it come back and a lot more. They've got the life insurance protection. We just want to make sure we educate them and make sure they don't cash it out and deal with any kind of tax liability or anything like that. So I hope you enjoyed this case study. If you have any questions, feel free to reach out anytime. If you'd like to see any samples or work with us, again, feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.